Welcome back, everyone. Today on the Joseph Carlson Show, we finally started earnings week last week, and that was just the beginning. We had a number of companies that are interesting, like Netflix, Domino's, TSM, report their earnings. But last week was just the start. It was like the appetizer to this earnings season. This week, we're really getting into the meat and potatoes. We're getting into the full entree here. We have some companies that are very big, important companies. Now, we have a list here of the most meaningful and important companies reporting earnings this week. And over the next 5 days, I went ahead and highlighted the companies that I think are even the most important. They are circled in red, and those are the ones that we'll be reviewing in this episode. For example, tomorrow, we have Spotify reporting earnings. This is a company that has a lot of disagreement. A lot of people have different opinions on it because it's both a fast-growing, profitable company, but it's also one that faces meaningful competition. They have basically all of big tech competing with them. Then on the same day, we have Google, one of the big tech companies. In fact, the first real big tech company reporting earnings this season. And this is one that investors in Meta will also want to listen to, even investors in Amazon. Google will set the tone for the rest of big tech for the QQQ. Google is an advertising company, and Meta investors will want to pay attention to this closely. So I'll be giving some opinions on Google, on advertising revenue, on everything about this company. Now, we also have Tesla reporting earnings. Every earnings season feels like it's critical for Tesla, and I think this one is as well. But there's a lot more that goes along with this earnings report than just the numbers. We'll be looking at what's going on with Tesla right now. And then we also have a high-quality compounding machine, Visa, reporting earnings Tuesday. I don't own Visa, but I do own MasterCard, so I have some thoughts on this one. Moving on to Wednesday, we have a value stock, AT&T. I'll be going over why this one is a terrible investment and why I've continually called this company a terrible investment for the past couple of years. And then we have another company that's, I think, a pretty good company. This is one that's made its way into a lot of high-quality growth investors, ServiceNow. That one continues to grow at a very fast pace. And then finally, we skip over to Friday, where we have one company that's just had so many issues. This one has had so many problems, which is 3M. We'll be taking a look at what's going on with this company. So we have a full week ahead of us. And like always, the purpose here is to give context and insight into what to expect from these upcoming earnings. Now let's go ahead and start off. We'll kick things off with Spotify. Spotify has been doing fantastic year to date. So far in 2024, the stock is already up 56%. So it's doing great so far. Investors are making a lot of gains if you bought it below $200 per share. But if we zoom out a bit, if we go over the past 5 years, it's up 104%, which is also great. That's a great return. The S&P 500, for example, is up around 80% over the same time period. But keep in mind, this comes with a great deal of volatility. Spotify traded up dramatically in 2021. And then it tanked and went down to below $200 per share. And then it recovered. So when you bought this one determines a huge portion of your returns. Just holding this one has been tough if you bought it at the wrong time periods. But overall, Spotify as a business is far more stable and gradual, and it's far more of a growth company than the stock has been. The stock has been highly volatile. The business fundamentals have been relatively stable. Overall, my feelings on Spotify have not changed that much over the past couple of years. I think the product is great. In fact, I'm a customer of it. I use Spotify every single day. I like the music features and the algorithms and playlists. I like the Spotify DJ X. It's really fun for when you just don't want to pick out something. You just want music to play. I like that AI DJ. I also like the ubiquitousness of it. In fact, I can transfer my listening from my phone to my car Apple Play to my Sonos speakers to any smart speakers really easily. Spotify, I think, does that better than anyone. So from a customer perspective, I really like the product. And I frankly believe that Spotify is one of the best companies to come out of Europe. It is a truly innovative, pushing forward tech company. Not something that we see a lot of out of Europe. So I really like this company, both as a stock and as a product. I'm a customer of it. The issue, of course, always comes down to the amount of competition this one faces. They face competition that's like death row. They face Google, Amazon, they face Apple, These are three of the most powerful, well-funded companies all going against Spotify. Apple's a big music player in the US. They're making a lot of progress across the world as well. So they have a lot of subscribers on Apple Music. They're executing rather successfully. Amazon, on the other hand, owns Audible, which is a competitor to Spotify's audiobook segment. And Amazon also owns the music player Amazon Prime Music. And then you have Google, which Google is kind of in and out of products frequently, but they are a big player in podcasts. They own a podcast platform, and of course they own YouTube. YouTube is a massive competitor to Spotify. In fact, I would argue, and I know this seems a little crazy, but I would argue that YouTube platform is a bigger competitor to Spotify than Apple Music. I truly believe that. Apple Music is a direct competitor to Spotify in terms of opening up an app and listening to music. But Spotify has become much more than that. It's an entire audio digital platform that now has ventured into video. So it's a video audio platform where customers can go to it as a portal to consume this content. Well, what is the biggest video audio platform in the world? Of course, it's YouTube. And YouTube competes with every part of Spotify. Consider this. Anytime an artist releases a new song, a new single, a new music video, where is that uploaded to? Well, it's uploaded to Spotify in most cases, but it's also on YouTube. And a lot of people go to YouTube to have the comment section, to have the community feeling of watching it with other people. So when Eminem or Drake or Kendrick Lamar, they release their hot diss tracks or whatever is going on in the world, those get uploaded to YouTube. And it seems like a lot of people are viewing them there because they get millions and millions of views there. So Spotify is competing against YouTube just with music. But then it gets worse than that for Spotify. They're also competing with podcasts. And in fact, one of the things that Spotify has claimed routinely over the past couple of years is that they are the largest podcast platform. They proudly proclaim that over and over again. But that may not be so true anymore. A new report suggests that YouTube is overtaking, and in fact, it has overtaken Spotify and Apple as the top US platform. This is of July 8th, 2024. After years of trailing competitors like Spotify and Apple, YouTube has emerged as the most favored platform for podcast consumption in the United States, according to Cumulus Media and Signal Hill Insights. The new data not only confirms YouTube's new dominance, but also delves into various aspects such as platform preference, content trends, and listener demographics. After chasing podcast success for years, the new growth has taken hold after YouTube and Google's parent company Alphabet phased out Google Podcasts in favor of predominantly their video platform. So there's now even reports suggesting that YouTube is as big or bigger than Spotify in podcasting. Now, of course, these can be contested and change over time, but Spotify undoubtedly faces a lot of competition. Now, the bigger challenge for me, and the reason that I'm not invested in Spotify, is actually not just because of the competition. It's not just because of Apple or Google. It's because of the lack of operating leverage. That is my biggest concern for this company. For example, if we compare Spotify to Netflix, on the surface, they seem like they're very similar companies. They're both in content and multimedia. They both sell monthly subscriptions. Seems like they're very comparable. But the difference is Netflix owns the majority of content on their platform because they are creating it. So it would be as if Spotify owned the majority of content on their platform because they were creating it. But that's not the case. Spotify isn't creating their content. They're licensing it from Universal Music Group and other big labels. So whenever Spotify makes a lot of money, the labels lean into them. They put more pressure on Spotify. They say you need to pony up more cash. They eat away at their margins, and they reduce the amount of operating leverage the business has. Whenever Spotify makes more money, the labels charge more money to Spotify. Whereas whenever Netflix makes more money, they just make more money. So with Netflix, you see explosive amounts of free cash flow growth year over year because they own the content. Once they've paid to create the content, they can indefinitely monetize it without any incremental costs. So to summarize, when I compare Spotify to Netflix, the reason I have a preference for Netflix is the operating leverage inherent in the business model. Now, in terms of this upcoming earnings for Spotify, I think it will be fine. Personally, I don't see any reason to be concerned about the company. Now, of course, anything can happen, so there's no guarantees. I wouldn't bet on it. but I don't think they're going to have any increased levels of cancellations. I think that people are too addicted to their Spotify service. They're too addicted to their playlists and algorithms. It becomes an integral part of their life. So I think as long as Spotify continues to keep their subscriber base, to keep incrementally growing, they should be fine and the stock should be fine. Now, next up, also reporting earnings on Tuesday, we have Google. This is a company that's the first big tech company this season to report earnings. And in my opinion, Google is an inevitable winner. And I want to explain why I think this stock is an inevitable winner. The first thing I must mention is disclose my position in Google. If you haven't been following the channel, I have a portfolio here called the Story Fund. It has $230,000 of value, $68,000 in gains. This one is mostly a high quality growth tech portfolio where I focus on companies that I really think have incredibly aggressive global growth. So we look at Google here as the third position. This is a large concentrated position with an 18% weighting. I currently have a total of $42,600 in this position. A lot of that is gains. $16,000 of it is gains. So this is one that I have been bullish on Google for a number of years, and I'm still very bullish on this company. My thoughts have not changed. In fact, I've become a little bit more bullish on Google over time because I see developments happening with this company that I really like. First of all, let's go ahead and just explain why I think this one is a long-term inevitable winner. Google's a company that is an advertising business. Now, you can debate whether or not you think the ad market is strong or weak, and that's what a lot of investors will be focused on. But it doesn't really matter. It doesn't matter if the ad market's strong or weak. All you have to know is that advertising is going to play a bigger role in the world in 10 years than it is this year. It's going to be bigger in the future. So whether or not the advertising market has a little bit of softness or strength, that is irrelevant. The long-term secular trend is that advertising is always incredibly important, and it's becoming more important in businesses and in the future. Google plays a key role in the advertising market. And in my opinion, in terms of the short-term debate, I also think the advertising market is strong right now. So in terms of advertising, Google's the biggest in the world, and they have long-term secular growth with advertising. Now, their search business is also not going anywhere. This has been a point of contention and discussion. A lot of people think that the search business is getting weaker, that ChatGPT and Bing are taking away customers. That was a big concern a year ago. Let's go ahead and just take a look at some of the data here. Okay, this is the cold hard data. What we have here is a KPI, key performance indicators. This is something that we've added into Qualtrim. It is specific, personally curated data for different segments of the business. And in this case, we have all the different revenue segments of Google. We have Google Search, YouTube Ads, we have Google Network, we have subscription, we have Google Cloud, and other bets. But for now, let's just take a look at the search market and observe the claim that people are making that Google's search monopoly is being broken up, that ChatGPT is entering in and taking market share. If we cross out the other segments of revenue, this is what we see. The revenue overall is incredibly stable and even increasing for search, going from $30 billion a quarter up to around $45 billion per quarter, which is just incredible. That's such an incredible amount of revenue. Now, some people might say, well, maybe they're not getting more organic search. Maybe they're just like charging higher prices. But this is search. They can't really charge higher prices. So what I see there is a search business that's getting stronger. Then we also have the other advertising business, YouTube ads. We can see how this has done over the past couple of years. Quarter by quarter, it continues to grow. YouTube is doing really well. Now, the growth isn't super fast. YouTube is already very, very large, but it continues to grow organically. And as more and more people like watching videos, as more and more creators get on YouTube and make videos, there's going to be more and more growth in the future. Obviously, I'm a little biased here, but I am still very bullish on YouTube as a platform. In my opinion, YouTube has no real competitors. You can name off Spotify, maybe, Twitch, maybe, but I don't think they really come close to YouTube. So the two businesses that have to do with advertising are both doing great, and they're growing over time. Whether or not there's softness this quarter or not, I don't think that's the most important thing. But if I had to guess, I think the advertising market is still strong. Then we get into the other parts of the business. And this is where I think the thesis on Google gets even better and better. When you look at the subscription business, for example, we can filter everything out, but just subscriptions. They're also growing that. They're growing it quite fast, 17% quarter over quarter, year over year. 17% growth is really fast. And again, this is subscription line of revenue. Very good. This is stuff like YouTube Premium. When we move on to the core thesis, I think one of the big pillars of Google, and perhaps the most important part of the company right now, is the cloud, Google Cloud. Look at the revenue growth of this segment. Compare it to any other segment. None of them even come close. It grew at 28% year over year from last quarter. It's also the part of the company that they've hired the most employees to manage and grow in the future. So a huge focus from Google is going on Google Cloud. That's where a lot of their new employees, a lot of their growth is coming from. The important thing with Google Cloud is not just that the revenue's growing and we see this nice growth trajectory, but it's also the margins of Google Cloud. We have another KPI here where I charted out just the margins of Google Cloud alone. And take a look at this. We know that Google Cloud was a money-losing business for the first couple of years. It had minus 50%, minus 60% margins. This is when they're hiring a lot of people, making investments way above the rate of their growth. But over time, the margins have come in as they continue to grow revenue faster than the rate of the expenses. And then in 2022, it went down a little bit. And then in 2023, Q1, we had the first positive quarter. Since then, it's only been a money maker. And Google Cloud is going to increase operating margins year after year after year. I think it will follow in the tracks of Amazon. We know that Amazon has margins upwards of 30%. So we could see the inverse of this chart. Operating margins climb from 10% to 20% to 30%. And have this be a huge, profitable moneymaker for Google. So I see this as the most compelling part of this story. We have a business that has lines of revenue that are incredibly good. YouTube is a kind of de facto monopoly. Google search is still very strong despite competition. And then you have the storyline of continued revenue growth from Google Cloud and operating margins going higher and higher. So right now, going into this earnings tomorrow, I'm just not concerned about Google. Even if we do have a big sell-off and it goes down 10%, let's say that we get those big scary headlines and people become fearful and they start selling out of Google. If that's the case, it's fine. Google makes a fortune and they can buoy the stock with their cash flows. Business is good for Google. This quarter should be good for Google. And although they do face new competition with AI and different things that seem like threats, we can always look to the data. The data shows that Google search is holding up incredibly well, that it's not losing any meaningful market share. The data shows that YouTube advertising is doing well. The data shows that Google Cloud is doing incredibly well, both in revenue growth and margin expansion. All of the data points to a company here that is very strong, that investors should not be concerned about this quarter. So I'm going into this quarter without much concern. And again, I'm not going to be concerned even if they have some weak guidance or something that causes a stock to go down. Those are small, short-term, small-term cyclical concerns. This is a story that is a long-term secular winner. Now moving on Tuesday as well, we have another big name reporting earnings, which is of course Tesla. This is a stock that there's a lot of passionate opinions about. Before I get into my thoughts and personal analysis on Tesla, I want to take a look at a couple pieces of data from this company. We can first look at the revenue of the company. The revenue is stagnant over the past year and a half. So we see that in Q3 of 2022, it was $21 billion. Last quarter, it was $21 billion. It's been right around that point. So the revenue has stagnated. They're looking for accelerating revenue growth to get this growth back on track. We look at the free cash flow of the company. The free cash flow went through a pretty big peak in 2021 when they had really high operating margins. They were doing really well in China. There was a lot of car subsidies. People had stimulus checks. This is a time where a lot of people are spending money upgrading their Teslas. They've had to do a series of price cuts on their Tesla vehicles. Interest rates went higher, which made financing vehicles more difficult, and the free cash flow has trended downward. So at Tesla, you're wanting to see the free cash flow go back up. The free cash flow estimates for this year are around $4.5 billion. That's not that great. In fact, that's really low for the size of this company. We're talking about a company that is projected to have free cash flows of $4 to maybe $4.5 billion. That's the amount of free cash flow this thing generates. And when we put this into perspective, this is a $792 billion company. So you're paying $800 billion to get back this year $4.5 billion. That's the part that I struggle with this company. But my issue with Tesla right now, the reason that I personally stay out of the stock is right now, Tesla is a very, very big company by market cap. So super big market cap, $800 billion company, and it generates a small amount of free cash flow. And even if we look at the earnings, you can look at it that way as well. Tesla, for example, is around a 2.5% to 3% weighting in the S&P 500. So out of 500 companies, it's getting a 3% weighting. That's a big weighting. It's a big portion of the S&P 500. And it doesn't contribute that much in earnings to the S&P 500. So it's a really big company that's not contributing a lot of earnings and a lot of free cash flow. And that just means that there's a lot baked into this stock. There's a lot of future already priced into this company. Investors are expecting such exceedingly good things in the future that they're paying ahead of time for them now. We have a company that trades at a 67 forward PE ratio. Now, you can talk about expensive companies. I own a couple of them. I owned Chipotle. I've recently sold out of this company for valuation concerns. It was a great holding. I made money on it, but Chipotle trades at a 55 forward PE ratio. When you're pulling forward 55 years of earnings, you're pricing in an incredibly bright future for a company that's already being priced in. Sometimes companies can go above it. Sometimes they really do a better job than even the best expectations. And that's what Tesla investors are expecting. They're expecting the future to be so bright, for robotaxi to be such a success, for the new vehicles to have such a commanding share of such a profitable business model that you can pay just about any forward PE ratio and it will still turn out to be worth it. So to summarize why I don't currently invest in Tesla, in order to invest in a company that has a 67 forward PE ratio and generates very little cash for the price you're paying currently, that's okay to do, but you have to have extreme levels of confidence that this company will generate enormous amounts of future free cash flow, very accelerated growth of free cash flow. And for me personally, I'm just not there. I just don't have the same degree of confidence. I wish I did. I wish I knew ahead of time that Tesla was going to do fantastic, but I just don't know for sure. And when you're paying for a company that's this big, that's this expensive, when you're paying this big of a multiple, you have to have that confidence. So Tesla investors have this extreme confidence that the future of this company is very bright. And they may be right. Maybe there's a scenario where that turns out. For me, I'm going to stick with companies that I feel much more confident with the future. For example, I think that Amazon has a very similar type of thesis as Tesla. Amazon is a robotics company with advanced robotics in their warehouses. Amazon is an AI company that's doing all sorts of stuff with AI. Amazon is a CapEx heavy company like Tesla. They share a lot of similarities. But Amazon is expected this year to generate around $65 to $70 billion in free cash flow, making the free cash flow yield not 0.5% like Tesla, but 3.5%. So there's just companies that I think are a better value proposition personally. But I get asked about that all the time. That's the reason that I'm not personally in the stock. Now, in terms of this quarter in particular, I'm going to make a prediction here that Tesla does not trade because of the numbers. I think the numbers will come in and they might have an immediate impact, a small one on the stock, but I'm going to make a prediction that the main thing behind Tesla right now is not the numbers, but it's the story. It's the narrative of the stock. It's going to be what Elon Musk says about upcoming robotaxi demos, the release of the new cars, the AI, full self-driving. I think that story is really how the stock is trading. Because if you were to calculate the company and base it on the free cash flow or the revenue growth or anything like that, it paints an entirely different picture about the company. What investors want to see with Tesla is not just the most recent 3 months of performance. I don't think any Tesla investor really cares about that. I think what they really care about is the bigger picture, the story of full self-driving, the story of the robotaxi network, those big things that Tesla could do to impact the world. So when we look at this upcoming earnings, I think it's going to be unique. I think the numbers are going to be kind of a small portion of it. And most investors will be looking to the earnings call and seeing Elon Musk's comments. Up next on the same day, we have a very busy day on Tuesday. We also have Visa reporting their earnings. Now, Visa is a very, I think, simple earnings report to go over because it's basically the same one every single quarter. The company is as steady and predictable as it gets, and that's why I think it's a wonderful investment. I don't own Visa directly, but I do own MasterCard, which of course has a huge overlap. If I was to put the overlap in perspective, based on my thoughts on it and the calculations, I think Visa and MasterCard are around 70% the same, around 30% different in their business model geography. So I do own a lot of MasterCard. It's one of my largest positions, and I chose MasterCard again because it's slightly faster growing, has a little bit more international exposure, it has a bit more value-added services. Having said that, Visa is at a lower valuation, so there are some trade-offs here. But Visa is a company that does generate a lot of free cash flow, and they do it consistently. Right now, the stock is trading at a 27 forward PE ratio. That's nothing expensive for this stock. It's trading at a 3.7 to 3.5% free cash flow yield based on whether or not you add in stock-based comp. So a 3.5% free cash flow yield, a 27 forward PE ratio, these are not really demanding numbers for Visa. Historically, the company trades around this area. So right now, most people consider Visa and MasterCard around fair value, around their intrinsic value. I happen to believe that they're both undervalued and their price is being pushed down by litigation that will in the future be resolved. If we look at the total amount of Visa cards, this also shows a very healthy picture for the company. Now it's grown around 4% to 5% over the past couple of years. Keep in mind, they're growing 4 to 5%, and then they also grow in the amount of transactions, and then general inflation helps them grow with the size of the transaction. The free cash flow per share has grown anywhere around 15% per year for the past 5 or 6 years. So we have very strong free cash flow per share growth. That is ultimately what propels this stock upwards. I don't have anything really negative to say here. Visa is a good company at a good valuation, and I don't see any concerns with this upcoming earnings report. So it's one that I would be more than comfortable holding into earnings. Now moving on to Wednesday, we have AT&T reporting earnings. And I wanted to highlight this one to give an example of an ongoing value trap. This company has been a value trap for years. When you go into lower quality companies, you play a game where you may be stuck in the company hoping that it will eventually go up, but it looks so cheap, you stay put. And that leads you to being trapped. That's why it's called a value trap. We have a company here that by the numbers trades at a very low valuation, a 7 forward PE ratio, a 15% free cash flow yield. These numbers are incredibly low, and you may look at them and think, man, that's incredible. I'm getting so much value when I buy this stock. It has to give me good returns. It has to go up and give me positive returns. So even with dividends being reinvested, which they cut their dividend, this company has not given positive returns over the past 5 years, while the market has gone up around 80%. So AT&T has dramatically underperformed the market while this entire time being a low valuation stock. The whole time it was a low PE stock. The whole time it was a high free cash flow yield, and it's down 22%. In fact, one of the best things that I can do to illustrate a value trap and how analysts and investors get caught in these things is Morningstar's analysis of this company. Morningstar, for the past 5 years, and again, this goes back to 2019, they have a chart of how they've rated the buy or sell of this company. 4 or 5 stars means it's a great buy. Means they're telling investors this company is very good value. Anytime the chart is in the blue means the company's undervalued. If it's in the orange, it means it's above its fair value. That's how they do these charts. Now, Morningstar has said for almost the entire history, the past 5 years, that AT&T is undervalued, dramatically undervalued. It's a 4 or 5 star buy. Yet the company has returned minus 22% this entire time. And even if you zoomed out further and further and further, it looks the same. It is a perpetually undervalued but poor performing stock. Because ultimately, it doesn't matter what the PE ratio is or the free cash flow yield if the company doesn't grow earnings, doesn't grow free cash flow per share, and in fact destroys investors' wealth. AT&T is a company that has always destroyed investors' wealth for at least the past 10 years. So as we go into earnings for AT&T, I don't think this quarter matters. The stock may go up 5% or down 5%. Those are short-term cyclical trades in the stock. Overall, AT&T is not going to be the type of company that generates a lot of wealth for investors. Now, also reporting earnings at the same time, Wednesday, we have ServiceNow, which is a much higher quality business. This is one that I've seen in a few super investors' portfolios as a high quality growth company. I looked at ServiceNow and did analysis on it, and I think it's a really good company. It's growing really fast. If we look at the revenue growth, this is a pretty good revenue growth line. It's above 20% for the past couple of years. It didn't slow down after 2021, which is really good. And it's just super gradual, high growth revenue. It's really remarkable. We look at the free cash flow. It's one of these companies that's growing revenue, growing margins at the same time. So you see the year over year free cash flow growth. We could switch this to annual instead of quarterly to see this clearer. That's what it looks like. Now, they do have a lot of stock-based comp. So it's one of these companies like Salesforce. In fact, I'd say this one's very similar to Salesforce that has that growing line of stock-based comp that eats up over 50% of the free cash flow. But the free cash flow is growing faster than the stock-based comp. So you're seeing operating leverage in the business model, which of course is a good thing. And then in terms of valuation, here's where things get tricky. ServiceNow trades at the more expensive portion of the market. It's one of those really high multiple companies trading right now with a 58 forward PE. So 58 years of forward earnings, that's pretty expensive, and a 1% free cash flow yield when you adjust for stock-based comp. Super low free cash flow yield, super high PE ratio. Typically, tech companies like ServiceNow, they trade at these premium valuations, these very high multiples, when they're able to sustain rates of growth above 20%. That is the most important thing. They have to continue growing and compounding above that 20% mark. Now that's really tough. If a company drops their growth rate, if the revenue goes down and they don't have a great story of suddenly increasing free cash flows, the stock will plummet. It'll go down 20, 30%, sometimes in a day. You've seen that happen with Netflix in the past. Netflix was a company that needed to grow above 20%. Once they said that their revenue was slowing down, they were losing subscribers, the stock plummeted. So the big thing with ServiceNow right now is the premium PE ratio is because of the high levels of growth. There's not many companies in the market right now growing at 24% per year. There's just not. So investors looking for this high growth, they're narrowing it down to a few companies like CrowdStrike, Palo Alto Network, ServiceNow, these really fast growing companies. And that's what keeps them in this basket of being in the premium valuations. So as I'm looking at ServiceNow right now, I think the most important thing for this company is the revenue growth. They have to keep that going. They have to keep growing really fast to justify these valuations, to keep it in this premium basket. If the revenue goes down, if you start to see softening, slower revenue growth, deceleration, I could see the stock trading down. For that reason, I'm not an owner of it right now. I'm an owner of Salesforce, which has already turned the corner of the story from revenue growth to free cash flow growth. Now moving on, we get to Friday. We have before market open 3M reporting earnings. And I wanted to take a minute to look at the downfall of 3M. This has been a case study in a company that has all the unattractive attributes play out to the detriment of an investor. If we look at 3M, this used to be a really great company. They had really well-known products. You had all their adhesives, you had their masks, you had their filters, right? You have all of this stuff that seems like they're great products that will sell across the world. And it's ran into problem after problem after problem. What went wrong with 3M? What happened here? The main problem with 3M is that it's not a compounding machine. And in fact, it's not only not a compounding machine, but it holds many unattractive attributes. And these attributes eventually catch up with the stock. For example, I'm looking for companies that are monopolies, that have pricing power and operating leverage. 3M is not a monopoly in anything that it operates in. It's not a monopoly in adhesives. It's not a monopoly in masks. It's not a monopoly in air filters. It has good market share, but there's many competitors for each of those, and in many cases, cheaper products for each of those. They don't have as much pricing power. They are competing with Chinese production companies that are making similar products. Their operating leverage is small. They have some of it, but they don't have a lot of operating leverage. Organic growth has been non-existent for the company. They're not growing in any part of the company. Overall, the revenue is entirely flat and it's negative on a real basis. They own lots of CapEx heavy warehouses, manufacturing, shipping. They're not selling digital properties or things that have no marginal cost of replication, they're selling things that they have to manufacture and ship. They constantly have to invest in new products, and in a lot of cases, those don't work out. So they're failed investments. 3M is another value trap, a company that does not have enough positive attributes, and it has too many negative attributes to be a quality investment. So going into this earnings on Friday for 3M, unless you're a super short-term investor or a swing trader, this would be one that I would avoid. Now that's going to be it for this week. And keep in mind, we have another big week next week with companies like Microsoft and Amazon, all these big companies reporting in the next week. So I hope you enjoyed. That's all for now. See you next week.